The amount of credit card debt owned by Americans has recently reached a new unfavorable milestone. According to the Federal Reserve Bank of New York's data issued on August 8th, they had crossed $1 trillion for the first time. Let's see how the credit card crisis in the U.S. is decreasing the standard of living for Americans. Now, according to a recently published Wallet Hub data, American consumers added $43 billion to their credit card debt in the second quarter of this year, which concluded in June. More than 3 times as much debt has been added to households on average over that time since the Great Recession in 2007 through 2008. Wallet Hub, a personal financial website, reports that both total credit card debt and debt per household increased by almost 8% in comparison to the previous year. Data from the Federal Reserve and the credit reporting company TransUnion served as the basis for their computations. By the end of June, the average household credit card debt was $10,170. The average household was slightly less monthly credit card debt than it did before the coronavirus epidemic that began in the early 2020, even though those sums are still climbing. Prior to the financial crisis, things were even worse. According to Wallet Hub, the average household debt reached an all-time high of $12,412. However, it appears that increased interest rates have clear effects. Up until March 2022, at the end of the first quarter of that year, the benchmark U.S. interest rate stood marginally above zero. The Federal Reserve then started to swiftly raise interest rates. Rates are currently between 5.25% and 5.50%, the highest range in over 20 years, following the most recent increase in July. This enables credit card firms to impose higher interest rates, which makes it more difficult to pay off bills. The Federal Reserve St. Louis office has released data indicating that credit card interest rates have reached a record high of almost 20%, the highest since the Fed started keeping track of them in 1994. The rate was approximately 16% a year ago. According to this data, rising credit card debt and vehicle loan balance contributed to a 1% increase in total household debt levels, which came to $17.06 trillion for the quarter. Before the epidemic, overall household debt increased by $2.9 trillion at the end of 2019. The debt balance of the New York Fed are normal and not inflated adjusted. The timing of these rises coincides with the rapid rise in interest rates to a 22-year high. Why does this matter? Well, the increase can be attributed to several factors, such as growing consumer confidence and purchasing power in the context of declining inflation. The power of extra savings accumulated during the pandemic, which are currently being used for experiences and travel, is also a factor. According to figures from the Federal Reserve Bank of New York, credit card balances in the United States climbed by $45 billion in the second quarter, up 4.6% from the first quarter to reach $1.03 trillion overall. Since the Federal Reserve began raising interest rates, the total balance on credit cards and other revolving accounts have increased. Yet the economy has not only held up well, but it has also grown stronger than expected. Companies and the government are investing in infrastructure and manufacturing facilities, among other projects. Consumer confidence has increased as a result of moderate inflation and a robust labor market. As of right now, bank deposits have increased by an estimated $4.1 trillion over the pre-COVID-19 amount. According to recent estimates from American Express and MasterCard, Americans increased their spending in the second quarter on experiences, restaurants, and travel. Now, just 6% of household bank deposits are made up of credit card debt, which is the lowest amount in nearly 20 years. It implies that consumers have adequate disposable income to pay off their obligations for the time being. According to Fed analysts, there are 70 million more credit card accounts open now than there were in 2019. That's before the pandemic. The percentage of Americans with credit card accounts increased from 65% in December 2019 to over 69% in the second quarter of 2023. By December 2013, almost 10 years ago, 59% of people had credit card accounts. What do they say? Now, according to the Fed researchers writing on the Liberty Street economics blog, American consumers have so far withstood the economic difficulties of the pandemic and post-pandemic periods with resilience. However, rising balances may present challenges for some borrowers, and the resumption of the student loan payment this fall may add additional financial strain for many student loan borrowers. What to look for? The effect of stricter lending guidelines on the insurance of credit cards to customers with lower credit scores. Every day, consumers are impacted as interest rates trickle down from the federal funds rate to credit card and mortgage interest rates. Morning consultant analysis Sophia Begg told CNN. Therefore, paying off that debt becomes more expensive with higher interest rates, and consumers will continue to take on more debt, which will put additional strain on certain households with tighter budgets. Now, according to Bankrate, the average credit card has an interest rate of 20.53%, which is almost a record high. Consumers have been negatively impacted by persistently high inflation and spiking interest rates despite the robust labor market, growing economy, and rising consumer spending. This is particularly true for those who did not refinance during the pandemic, looking in ultra-low interest rates and pocketing $430 billion in the process. According to the Bank of America research early in August, more consumers were accessing their 401k funds due to financial difficulties. 15,950 persons, or 36% more than the second quarter of 2022, requested a hardship withdrawal in the second quarter of this year compared to the first 3 months of the previous year. Even while only a small percentage of plan participants are taking hardship withdrawals, this is another sign that financial cracks may be appearing in households. According to a plethora of data, Scholes stated people are doing really well. Delinquencies are low, unemployment is low, and debt to expendable income ratios are okay. However, individuals can only manage a certain amount of hard debt before delinquencies significantly increase. As per the most recent New York Fed report, new delinquencies are still rising from their previous historic lows. The moving average of auto and credit card delinquencies are at their highest point since the first quarters of 2018 and 2012, respectively, even if new mortgage delinquency rates are still below pre-pandemic levels. According to New York Fed analysts, while they have increased, they haven't yet reached a level where customers are facing widespread financial hardship. According to the study, American consumers have so far withstood the economic difficulties of the pandemic and post-pandemic period with resilience. Yet some borrowers may face difficulties due to the increasing balances, and many borrowers may experience further financial strain when student loan payments resume this autumn. October will see the start of federal student loan payments again after a 3+ year break caused by the COVID-19 outbreak in the Biden administration's debt forgiveness program. According to New York Fed experts, the current repayment plan implemented by the Biden administration might lessen the blows of debtors, as they told reporters on Tuesday. However, not all budgets are made equal, and some households could find it more difficult to make the additional monthly payment. Credit cards are a common method of borrowing for Americans. 82% of adult Americans owned credit cards in 2022, with 48% of them having a balance. Debtor accounts become delinquent when payments are not made on outstanding balances. This lowers the borrower's credit score and incurs interest and other fines. Accounts closure and loss of credit access are the outcomes of severe delinquency. The global financial crisis saw record highs in credit card delinquency rates. Recessions can cause a rise in credit card delinquencies for a number of reasons. Losing a job can lead to delinquencies because people may decide to cease making credit card payments altogether or cut them as a result of their reduced income, a factor that increases during recessions. Another reason might be that banks eliminate promotional offers like 0% APR balance transfers when credit card conditions are tight, which prevent customers from rolling over past due debt. However, households maintain record low delinquency rates during the COVID-19 recession and immediately after because of forbearance programs, reduced spending during lockdowns, and significant government subsidies. Then, towards the end of 2021, credit card delinquency started to rise. A credit card account is considered delinquent if it is 60 days or more past due, with the exception of accounts with extremely negative debt, which is 120 days or more past due. Consumers' balance sheets appear to be being stretched by inflation and rising interest rates. However, it's unclear if this is reaching a breaking point. Earlier, due to predicted fiscal deterioration over the next 3 years, a high and rising general government debt burden, and a gradual decline in governance over the past 20 years, the global credit rating agency, Fitch, lowered the U.S. sovereign rating from AAA to AA+. According to Fitch, the U.S. rating has been downgraded due to the anticipated fiscal deterioration over the following 3 years, a high and rising general government debt burden, and the erosion of governance compared to AA and AAA rated peers over the past 20 years, which numerous debt limit standoffs and last-minute agreements have demonstrated. That's all for now, and for more videos like this, subscribe to our channel. Thanks for watching, and we'll see you in the next video.